You might hear institutional investors talk about leverage. Here is how individual investors can create their own version using simple portfolio management. In finance, leverage generally means using borrowed money or derivatives to increase the potential market exposure of an investment portfolio. Homemade leverage often refers to an investor holding a portfolio that is more than 100% exposed to broad market movements. Investors create this exposure by borrowing from their brokerage, using derivatives, or tapping into credit lines to hold more assets than their cash allows. The trade-off is clear. You gain the potential for higher returns, but you also take on interest costs and the risk of significant losses. Remember that borrowing money has a cost. If the interest rate on your debt exceeds your investment gains, your net return becomes negative. Always be aware that when you borrow to invest, a market downturn can hurt your portfolio much faster than it would with cash alone. Understanding leverage is key to managing risk. Thanks for watching, and remember to subscribe for more simple breakdowns of complex financial topics.